Saturday, August 30th, 09:59 a.m. New York time. Welcome back, investors, to Winning Wall Street's Money. It's the end of the month. We have this new coming month Federal Reserve meetup, their vote on interest rates. Those are the overnight interest rates. You know, the Federal Reserve has two policies. So they're limited what they could do. Keeping inflation down. Tariffs can add to inflation. Tariffs are adding to inflation. You have another federal agency called the U.S. Treasury. They sell financial instruments to fund the government because the government does not collect enough tax revenue from all sources being income, being import tax, business taxes. The federal government does not collect enough. So they sell, again, U.S. Treasury yields. There's different durations. Those rates fluctuate. The yields fluctuate during the market hours. Well, obviously, the U.S. Treasury is closed right now, and Monday's a holiday. But this is a monthly chart, meaning each candle's a month. And these yields are long duration. They're 30-year, committed into invested in a 30-year yield. Bottom is the low for this whole duration. Currently for the year, here's the low of the year. Here's the high of the year. Huge consolidation here for the past several months. So when the U.S. government, U.S. Treasury Department sells these yields, who buys them? Some nations buy them. Some businesses buy them, such as your financial institutions. Some individual investors buy them. When these yields go higher, the government pays a higher interest rate to the money they're borrowing. Us, the taxpayer, are paying a higher interest rate to others to borrow money from. So for the month, we made a lower high. We also tested the low of last month. That's the 30-year one. This is a 10-year yield. Again, shorter duration. Again, here's the high for the year. Here's the low for the year. Huge consolidation. We closed below last month, making a lower low, lower high. So we have both the 10 and the 30-year yields, lower highs, lower lows. That's good for us, the taxpayer, that we're paying less interest. The money we're borrowing, if the yields go up, we'll be paying more interest. Right now, the government, your government, approved by the voters, only pay interest on the debt. That's not a good thing. Do you carry a credit card balance or you only paying the interest? Here's a 5-year yield. Look what we did. We made a new low for the year. So the shorter duration made a new low. That's a 5-year commitment. And this is the 2-year one. It also made a new low for the year. So all these in common, they all made lower highs, lower lows. So they're trending down currently. And like I said, these shorter term ones, the 2-year, 5-year, made new lows for the year. Well, if you're looking to earn higher interest rates, now you'll be leaning toward these longer duration ones. That's good for the government because these things are auctioned off. And depending on how many buyers and the order we want to get filled, such as if we need to raise more capital, we're going to have to raise the yields. This is the U.S. debt as of Friday. Yeah. Currently, the debt is over $37 trillion. I shared this a few weeks ago when we broke 37 trillion. When we broke 37 trillion, all these other numbers was zero. That was about 2-3 weeks ago I shared that. Since then, when we broke all-time new high 37 trillion, we added additional $310 billion. Where's that money being spent? In September 17th, the Federal Reserve meets and they vote. If they're going to change or leave interest rates alone. This is a financial exchange that shows what the sentiment is. So right now, 86.4% anticipate the Treasury will lower yields, lower interest rates. That's the overnight one. Currently, here, 4.25, 4.50, and they're expecting them to be lowered. Where 13.6 of the market community has a different sentiment, they can be left unchanged. Again, these things change when the market's open. So again, this event takes place this month, 17th September. Again, that's overnight lending between the financial institutions. That's not for you getting your mortgage. That's not for you getting a car loan. Nope. So if you get a car loan. So now we're looking at U.S. Treasury Department. They sell these financial instruments. I told you, I showed you the chart. This is more of a variety. 1 month, 1.5 month, 6 month, 1 year, 5 year, 10 year, 30 year. Beginning of this month, look all these numbers, the beginning of the month, I'm going to go across this. See the 20 year, 4.79, and the 30 year, 4.81. So it looks like here, the highest yield you could have received for a financial instrument would have been the 30 year one, 4.81. That was on that day. Let's go to the last trading day so far. See these? So 4.92. So whoever bought that on the first of this month is locked in at that yield. It's a penalty if we close early. But if you waited till the last day, you would have collected a higher yield, more interest. Got it? So when you see these, the 10-year one, 4.23 on the first, and they're the same. This is what reflects, again, especially the 10-year one, the mortgage rates, plus your broker mortgage company adds a few points depending on your credit score, credit risk, income. So this is more important. We should be looking at for your credit card interest rates, car loans, mortgages. This is mostly neglected. Not a good thing. Yep. Thank you as always, spending just a little bit of time with me. That's it for the video. Thank you for watching.